JP Morgan Chase CEO Jamie Dimon warning of turmoil ahead in the banking sector. More to come, he says. At the bank's Investor Day on Monday, Dimon pointed to the likelihood of higher rates and tightening credit. For more on this, we want to bring in Thomas Michaud, who is the CEO of KBW. That's a Stifel company. And Tom, thanks for being here. It's good.
Good morning, Becky.
Let's talk about where things stand. It feels like we've gotten through some of the worst of the banking turmoil, but when you have somebody like Jamie Dimon saying there could be more troubles ahead, that makes all of us kind of sit up and pay attention.
Yes, whether or not we technically get a recession or not, I think it's actually going to feel the same way, which is the economy's slowing. The surprising thing is that credit in the banking industry, the credit costs, have essentially been zero for so long. It's inevitable that we're going to have more credit expense going forward. Also, we're dealing with these surge deposits that are still leaving the banking system. That was happening even before we had the recent bank failures. So banks are going to have fewer deposits to lend out. I think that the credit tightening story started 6 months ago, even before these bank failures. So this is happening right in front of us right now.
You think bankers have figured this out at this point now that they've been stressed in these ways? And are they changing their behavior?
I think the banking industry dealing with this situation, because remember, the COVID response was so exceptional. No management team's been through this before. The size of the quantitative easing, now the tightening, the surge in deposits that happened. I think the industry, by and large, notwithstanding the significance of the 3 big bank failures we just had, don't discount that. But I think the industry is actually doing a pretty good job of managing its way through this at the moment.
You know, there's a lot of criticism coming toward the regulators for not having kind of seen what was happening at Silicon Valley Bank and the other banks. You just testified before Congress last week and talked about what needs to be done to change the scenario. We are sitting in a situation where, look, community banks may be threatened at some point.
So what I talked about is that there have been 2 major changes that have happened since deposit insurance was last changed 13 years ago. One is the speed of money is exceptionally fast and faster than anybody would have thought. When 85% of Silicon Valley's deposits leave in a day and a half, that's shocking that no one saw coming. The second is the too big to fail theme is even bigger than we thought it might have been. So I called for increasing commercial and retail transaction and operating accounts, day-to-day operating accounts, increasing that insurance so that way depositors don't decide who their bank is going to be just by how big it is, instead in terms of the service and the products they get. The second thing I said is we need to restart healthy bank M&A. There's been really a pressure against healthy bank M&A. We need it because the bigger banks need more competitors, and we also need the healthier banks to take care of or resolve the weaker banks before it gets to the deposit insurance fund and becomes really expensive. We've learned it's really expensive when that happens. Let the private sector do it. They will do it if they had regulatory support and clarity on how these banks can merge, because we've had 2 bank mergers turned down pretty publicly by the regulators recently.
The speed of money in terms of deposits, but also the speed of the capital markets in terms of how shareholders react with the stocks is faster than before and in past banking crises. And I'm just wondering what your thoughts are on this, because there was an article in the Journal today about PacWest being the newest meme stock, which would imply that it's having outsized moves. The difference between, a PacWest or a bank and an AMC, there are many obvious ones, but the equity is part of the capital structure for a bank. And so a huge drawdown really, impacts a bank. So what are your thoughts on how all this plays out, and how can we put up guardrails? I don't know what kind of guardrails you would put up.
So, Melissa, when I went to Congress, I read President Roosevelt's speeches about why we had an FDIC. It's because the banking industry is different than other companies. It's built on the confidence of the deposits. Folks can get really scared really fast about the safety of their money. And remember, the FDIC's first response after Silicon Valley's failure was not to give their money back to depositors. They were going to get a certificate. Didn't happen until Sunday. They said you'll get your money back. That made people really nervous. So we need to break this feedback loop that you can go on social media, you could talk about taking a run at a bank, you could talk about telling other people to take your money out of the bank, and then get the reward of the stock price going down. That feedback loop has to be stopped. I know there are calls for banning short selling. I'm not in that camp because I think the greater solution is deposit insurance reform. And that's why I've been advocating as aggressively as I have to protect these mid-sized banks especially.